We're back on Morning Movers. Another member of the AMZN, Amazon, set to report earnings this afternoon. The street is expecting adjusted EPS of $1.33 on revenue of more than $162 billion. The focus will be on Amazon's AWS cloud. That is expected to grow 17% year over year. Investors will also look for the impact of tariffs on the retail side. I want to bring in Tom White, senior options contributor, for a look across the chart and an example trade. Why don't we start out with this chart, Tom? It's been an underperformer compared to other members of the AMZN, but there are some who say the time has come for Amazon to run. What are you noticing in the chart?
Well, you can take a look here at the one-year, one-day chart. It's a roller coaster, right? We went to all-time highs at the beginning of the year, towards the end of January, early February. We fell steeply into those April lows, but this stock was already on a downtrend prior to that. They said that tariffs were going to negatively impact the stock moving forward, especially the retail side of their business. But that didn't come to fruition. Now we've rebounded over 55% from those April lows, getting close to all-time highs. The stock closed about $230. It's going to be opening about 237 today. But you can see here, we had a death cross where the 50-day moving average closed below the 200-day moving average, and that was in April when we saw some of those lows in the overall market. But now we've seen the golden cross where the 50-day crossed back above it. It's probably, constituted as a bullish trend, but at the same time, we're starting to get frothy here a little bit. The RSI levels, relative strength index, getting close to that 70 level going into these earnings. But as we've seen from some of the other tech names that have reported, that doesn't seem to matter because there's upside potential in a lot of these stocks. But if you take a look at this, you got the 50-day moving average down there at 216. That's probably going to be a good base of support if this stock does fall. The 200-day moving average all the way down at $209. But stock's going to look like it's going to open up here about 237.
Okay, and now what's the approach for an example trade for this one? I know you've got a couple examples here.
Yeah, we've got two of them. So we're going to kind of use the same sentiment here. If you're bullish on this name, there's two ways to play it. The first one I'm going to look at, a little bit more aggressive, where we're going to buy a call vertical. We're going to go out to the August 15th monthly cycle, though. So we got 15 days, not a pure earnings play. Implied volatility levels, while elevated going into the event risk of earnings, still relatively low over a 52-week period. So I looked at going to the August 15th. We're going to buy the at the money or slightly in the money 235 strike call. That's bullish, right? It's got that higher delta. It reacts more like the stock. Then against it, to offset some of the risks on this bullish trade, we're going to sell the 250 strike call. So a bullish $15 wide call vertical. We're going to pay roughly, if the stock opens up here around 237, probably anywhere between $5.70 and $6 at this point. But if I pay $5.70 debit, that's going to be my risk, $570 per spread, with the potential to profit about $930. So you've got to break even about $240.70 to the upside. That's only going to be about 1.5% above the current share price. The option market is pricing in about a plus or minus 5% move in the stock post earnings, one-day move of about $11 either way. So take that into consideration. You only need about 1.5% to get above that break even. Now, that's a little bit more aggressive bullish here. We've got another position that's still bullish, but it works on probabilities, higher probability of success. But it flip-flops your potential risk reward on this. So the second trade we looked at is in that same August 15th monthly cycle, 15 days to expiration, where we're going to sell an out-of-the-money put vertical to take a neutral to bullish type of stance. We're going to sell the 225 strike put. That's going to be about $12 out of the money to the downside. And then against it, to make it risk defined, we're going to buy the 215 strike put. So a short $10 wide neutral to bullish put vertical. You're going to collect roughly about a $2 credit if we open up here about 237. See, that takes your break even all the way down here, all the way down to, what do we got our break even at? 223 to the downside. That's going to be about a 6% cushion outside of that one standard deviation move that the market's expected. So even if the stock does go down, I can still be profitable on this one. We just need the stock to stay above 223, but it's still a bullish trade just like the other previous call vertical I looked at.
All right, two example trades there for Amazon. Those results due after the close of trading today. Thank you, Tom.